Welcome to Massive Passive Cash Flow, the podcast that guides professionals to financial prosperity. Join our community and let's start building your wealth. Here's your host, Gary Wilson.
Welcome back to the Massive Passive Cash Flow podcast. I'm Gary Wilson, your host, and we're glad to see you again. If you wouldn't mind, if you haven't already done so, would you please subscribe to the podcast? We're on 30 different channels, including your favorites, Apple, iTunes, iHeartRadio, you name it, it's out there. We appreciate you doing that. And while you're out there, please go visit the globalinvestoragent.com website. This is where you can find real estate agents who are trained to work with you and I, the investor, okay? And if you are an agent, click on the Learn More button, because there's no better time than now to figure out what you're going to do in this changing market. This is the answer. I'm telling you, you need to learn about it and make some valid decisions. Not the time to panic. It's time to prepare, and this will show you how. So, by the way, we've got a great guest today, David Garofalo, all the way from beautiful Vancouver, Canada. And David, we're glad to have you on board. Thank you so much for joining us.
Well, thanks for having me on, Gary. I'm delighted to be here.
Great. Hey, if you wouldn't mind, I'm always intrigued to meet people and make new friends. And I've read about you, and I'm just thrilled that you're here because it's a great subject. So if you wouldn't mind, would you kick us off a little bit of background? How did you get to where you are and what you're doing now?
Well, actually, if I go way back to the 1980s when I started my business career, I actually qualified as a CPA with Deloitte and then entered the mining space in a very junior capacity and worked my way up, initially with a base metal producer producing copper around the world with a company called Inmet Mining. And then I became the CFO of Agnico-Eagle, which is now the third biggest gold miner in the world. And then I became the CEO of Hudbay, which is one of the biggest copper producers in Canada with operations globally. And then I ran Goldcorp until 2019, which at the time was one of the biggest gold miners in the world. And I led the merger, the largest merger in gold mining history, $32 billion with Newmont in 2019. And Newmont today stands as the largest gold producer, both by market cap and production. And then a couple of years ago, I founded Gold Royalty Corp. IPO'd it on the NYSE American under the trading symbol GROY. And we've become the fastest growing royalty company in the precious metal space in the world. Nice. That sounds like a pretty impressive background. I know Deloitte's obviously one of the largest accounting firms in the world, excuse me. And I think you had started off were you in Toronto then when you started with Deloitte? I was. I moved to Vancouver 7 years ago to run Goldcorp. So really, I'd been in Toronto my entire career up to that point. Toronto, many people don't realize, is the mining capital of the world in terms of ability to raise capital. There's probably more mining companies based out of Toronto than any other jurisdiction or any other major city in the world. London probably being a close second. And so it was a very deep pool for opportunity in the mining space. And I built a franchise over 33 years in the sector and largely in Toronto, but Vancouver is very prolific on the mining side as well. Yeah, I'm glad you mentioned that because I was not aware of that. And I know of course, I lived in London, Ontario for several years. And yeah. I forgot to mention this. I actually lived in the Danforth in Toronto for a bit. Greek town. Absolutely. Yeah. Yep. Papa's Grill was one of my favorite restaurants. Yeah. And great place to be. For those listeners, if you've never been to Toronto or, by the way, Vancouver, I highly encourage you to visit those two beautiful cities in we call it the North, right? Wonderful people, very international. Oh my gosh, it's just an amazing place. So, so back to the subject at hand when it comes to gold, and this is really nice that we're doing this because the market is in transition right now globally and particularly in the U.S. And people are looking for, what do we do? Where do we go? Oh my gosh, inflation's eating our money alive and the stock market's down. We've got this potential housing bubble. Oh my gosh, it's just, life can be stressful, but can also be very peaceful when you have options. And this is certainly, one of those options. So if you wouldn't mind, could you go in a little more deeply about the commodity, I guess I'll call it commodity of gold, and why might that be a really good alternative right now for folks looking for a place to go, Yeah, well, we're in a point in the economic cycle where we're experiencing inflation very much like we experienced in the 1970s. We haven't had a big inflation cycle in a long period of time. And there are many similarities between what we're experiencing now and what we saw in the 1970s. Early 1970s, we saw a vast increase in money supply, and that was driven by Richard Nixon's decision to decouple the US dollar from the gold standard. And he did that because he was trying to finance a war in Vietnam. He had to print money, he had to issue debt. Gold wasn't going to do it for him. He needed to expand money supply quickly. And that led to a big inflationary cycle. And that was exacerbated by the fact that we had an oil embargo in the 1970s imposed upon us by the Arab world.
Right.
And, guess what? We have an oil embargo now. It was self-imposed because we're not buying Russian energy, but it's having the same effect. And we also saw supply chain disruptions. That was an oil-based economy in the 1970s. And to a large degree, it is today. We've had supply disruptions driven by the COVID crisis. Back then, it was more because of the oil embargo. But we're seeing empty grocery shelves again, lineups at gas stations, high gas prices. A lot of similarities between the 70s and today in terms of the inflation cycle. The one big difference I see, though, is that the debt levels in the 1970s globally were much lower than they are today. Back then, global debt to GDP, so that's including government debt, corporate debt, and personal debt, was about 100%. And so basically the size of the global economy. And that was actually quite reasonable. And it left Paul Volcker, who was the head of the Federal Reserve at the time, the latitude to raise interest rates dramatically so that he could tame inflation. Today, global debt to GDP is 350%. So it's 3.5 times the size of our global economy. There's very limited latitude for central banks to dramatically increase interest rates. Paul Volcker brought interest rates to 20%. To tame inflation that was 14 to 15% at the time. It's inconceivable that the central banks today will raise interest rates to a level above where inflation is, because it would very well bankrupt some of the developing world and governments there, and could very much put the US fiscal balance into peril, because right now, in the last 18 months, debt service in the US is doubled from about $500 billion a year to $1 trillion a year. So 1 out of every $7 in taxes raised in the US today is going to debt service. Could you imagine if they raise interest rates another couple hundred basis points, what that would do to debt service? It really would put the fiscal balance in the US in peril, and it would bankrupt the developing world. So what I would say is I think we're likely to see the Federal Reserve and other central banks pivot quickly in the next 6 months to a year, much more quickly than it's probably advisable given the inflation we're experiencing. Mm-hmm. And so that means that we're likely to see inflation entrenched for the foreseeable future. And the thing about inflation is it eats your savings, right? It eats away at your purchasing power. And that's where gold becomes a very, very important asset class to secure your purchasing power, secure your capital, secure your wealth. Gold yields zero, but the reality is treasuries today with inflation yield negative. Interest rates are 4 or 5%, but inflation 6, 7, 8%. That means your real returns are negative. So gold is where you want to be to preserve your capital. And that's why it's such an important asset class in inflationary times.
Yeah. Well, I appreciate the explanation. And what's interesting is, I was growing from a child to a teenager in the 70s. And, got my driver's license, and that would have been 1979, I guess, 1978, 79. And gas prices, I remember they went from 22 cents a gallon to like $1.25. We thought, oh, this is the end of the world. This is terrible. Now we'd be happy to have $1.25. But the sad part was the interest rates on mortgages. And, I was fortunate enough in my college years, my college roommate in freshman year at university is named Socrates. His dad was a Greek immigrant and was a big investor in real estate, taught us how to invest. Never gave us money, but, showed us how to acquire real estate assets. And at the time, interest rates were still very high. So we assumed mortgages and things like that you could do. And that was my beginning. That was my normal. And I remember prior to me getting my license, literally lines at the gas stations, blocks and blocks long, just crazy stuff. And I'm just a kid, the Vietnam War was ending, crazy times. But I guess what I'm getting at here is, as crazy as that was, I do remember Nixon taking us off the gold standard. And looking back, I remember, I'm thinking, okay, this can't be good. I mean, gold is a tangible asset, and that to put on the dollar bill, fully guaranteed by whatever the words are, full faith and credit of the U.S. government. That's all, sounds like smoke and mirrors to a lot of people, but it's based on the GDP, is what it is. So here we are now, a full just about 50 years later, and our debt is 3.5 times, 350% more than a GDP is worldwide. And I knew in 2012, listening to actually an accountant, by the way, speak with a group of investors in Charleston, saying, if nothing changes by the year 2022, 2023, because of the level of debt and rising interest rates, there's going to we'll hit the point of no return, or we have to lower our credit ratings dramatically on the U.S., and that is not a good thing, So to me, looking for something tangible, and I'm already familiar with real estate, but I don't like to have all of my eggs in one basket. And I think gold is a tremendous alternative. Now, are there other alternative hard assets? People. The reason I'm asking is I'm at my mother's house now, and you see that I don't have a television, by the way, David. I haven't owned one in 7 years now. But here, there's a television on 24/7. And because you can imagine what she's watching is commercials. That's why they call it commercial television. Well, a lot of the ads are buy gold, buy silver, but I don't really understand why. Is there a correlation between the two, or is it two totally different, unrelated commodities, and maybe you should have both? Or what's your take on that?
Well, silver is an interesting asset because quite often investors buy it as a proxy for gold. It's much lower unit cost. Silver typically today is $20 or so per ounce. Gold is close to $1,900 an ounce. So people feel they can get more ounces for their dollar. And so they use it as a proxy for gold. And quite often the ratio of the gold price to silver price in a bull market for precious metals tends to narrow dramatically. In a bull market, typically the gold to silver price ratio is 40-1. Today, it's more like 80-1. So what that tells you is if we're in for a bull run in gold, silver is likely to outperform gold, because people will look at silver as a cheaper alternative to buying gold. Okay. And so it does tend to get that overflow of demand from the gold sector.
Okay. All right. Well, this is good. And I'm trying to piece together in my own mind, and also for the listeners. So how does one actually participate? I know you can buy it outright directly. You can buy it as part of a mutual fund. What's the mechanism, or how does one actually participate? And can it be leveraged too? Can you borrow a margin account, 1 to 50, 1 to 100, like you can do with other stocks and commodities? That's probably a giant question.
It's a good fundamental question, actually. Okay. And if you believe in gold as an asset class, if you think it's likely to run because we're in an inflationary cycle, and by the way, gold is still not anywhere near its all-time real high. If you look at where gold was in early 1980s, at that point in the inflation cycle, it reached about $850 an ounce in 1981. Inflation adjusts that to today, that would be $3,000 an ounce. So we're far away from the cyclical high for gold, even though we are in an entrenched inflationary cycle right now. But, and if you buy into that thesis that gold as an asset class is going to do well, you have to ask yourself, well, how do you play it? And you've hit on it. You can buy the physical gold. You can go to a bank, show your driver's license, get the physical gold, find somewhere to store it, safety deposit box underneath your mattress, which I wouldn't recommend, but there's ways to do that. It's not terribly efficient, but you can do it. You can buy an ETF. If you're looking at ways to leverage it and do it on margin, there's an ETF on the NYSE called GLD. That's physically backed by gold. It trades at about, the price is equivalent to about 1/8 of an ounce of gold each share. And so that's like buying an equity, but it physically backed at the Bank of New York. They have a vault. And every time somebody contributes into the fund, they buy more ounces to physically back the gold. It gets audited every quarter, so you have the security of knowing that those physical ounces are there. But when you buy physical gold, whether you buy it yourself or buy it through an ETF like that, it doesn't grow at all. It stays an ounce, and in fact, you lose a little bit of value every year because of the storage costs. But if you fundamentally believe in the gold cycle, you'll do well. But if you want optimum leverage of the gold price, then you start to look at mining equities, because typically if the gold price goes up 10, 20%, their profit margins should go up 30, 40, or 50%, because, their cost structure should be stable and their margins should expand disproportionately higher. So that provides that leverage proposition. And quite often mining companies are drilling for more gold. So if they find more reserves in the ground, you get exposure to that. The only problem with mining equities is that their costs are not necessarily stable. They're not immune from inflation in the general economy. And I've experienced it. I've built 15 mines in my career. I've operated countless more. So I know that cost pressure dynamic, what that can do to your margins, even in a rising gold price environment. So that's the challenge. The other way to play it is buy a royalty company. And what a royalty company gives you is exposure to the top line of the mine. And so I founded this royalty company 2 years ago. And what we do is provide capital to the developers, the explorers, and the operators to help them finance the construction and expansion and optimization of their mines. And what we take in return is a royalty, a percentage of their top line of their gross revenue. That insulates us from their costs at the mine site. So if their costs inflate, doesn't matter. We don't care about the margins of the mine because our exposure is entirely top line. And we get exposure to their exploration upside. So as they drill out their deposits, our royalties extend to the growth geologically in their reserves, not just on the existing reserves. So we get optimum leverage to the gold price, optimum leverage to the exploration of our operating partners, while insulating you from cost inflation. Because again, we're not exposed to margins, we're top line exposure. Right. Last year, for example, on the exploration side, we have 215 royalties in our portfolio. Our operating partners invested $200 million US in exploration on their properties. We contributed nothing to that. Okay. So we get all of that exploration upside, which they finance entirely. Once we own a royalty, there's no cash calls. We own it in perpetuity. So we have 215 royalties, and all we do is wait to harvest the returns on those royalties. As the production ramps up, we just collect checks. Yeah.
Well, that actually sounds like of the options, sounds like that is the best option,
Particularly in an inflationary environment. And the other aspect of our business is it's eminently scalable. I have 8 employees. When I ran Goldcorp, I had 20,000 employees. Wow. Today, I have 8 employees. And with those 215 royalties, I could go to 2,000 royalties with the same 8 employees because we're essentially administering contracts. We're not running the mines. So we can keep a very low G&A footprint. And as our revenue grows, that goes right to the bottom line. In fact, 10 months after our IPO, we introduced the dividend. We pay a 1.5% yield on the stock, which is remarkable for any company 10 months after their IPO. But given the growth in our revenue, which is projected to be 60% compounded annual growth in revenue over the next 5 to 10 years, you can imagine the prospect for dividend growth for our shareholders as a result of that.
Oh, yeah. Well, what's intriguing is the way that's structured, the way royalties are structured is in most cases, when you own part of a company, and I've been in that situation before, where, everybody, it all looks good on paper when you start your business. But if you're in business long enough, it's generally going to cycle up and down and you'll hit a rough patch. And if you exhaust your reserves, and your expenses are exceeding your income, you got to do a cash call, and that's no fun. So to be able to invest in something like this without have that worry, it's like you're maximizing your upside potential while minimizing your downside risk, and that to me that should be part of any decision process and any investment is what's the upside potential and what's the downside risk, and obviously you want more upside potential and less downside risk. But I don't know of any perfect investment, but this one's sounding pretty good. Now I have to ask this question because I know it's going to come up from people. The crypto world is now, it's like in every facet of life, it maybe is not reached full consumption by the average person, the average, human being. It's probably an early adapter stage, but people are buying houses with it. They're buying cars. They have credit cards, they're buying groceries and gas and all this kind of stuff. And I know people are saying, hey, if you thought about gold, but do it through crypto. And the answer is no, I haven't. So I don't know if you're familiar with that or people have approached you that, is it even a possibility or what's the risk factor to that and what's the potential growth? I just don't fully understand it. That's why I'm asking. And I know people it comes up almost daily now, Hi, I just wanted to take a moment to say thank you for participating in the Massive Passive Cash Flow podcast. Also wanted to let you know that the book Global Investor Agent is officially out in print and in Kindle on Amazon. You can get it by clicking on the link right here. If you are an agent, definitely grab yourself a copy. This book, guys, was not just written by me. I also included 8 other investor agents from around the country. And I didn't just handpick them. I literally opened it up to the entire audience, and it was first come, first serve. So you're going to get feedback from brand new agents all the way up to top 25 team leaders, some on my team, some are not on my team, with valuable insight and instructions and guidance and actual checklist to follow to not just survive, but thrive in this market. I know you're looking for that advantage, and this is it. By the way, if you are an investor, grab a copy for your agent. And for everybody, all profits from the sale of the book, Kindle and print, all go to the Healing House Foundation, 100%. Thank you for doing that too, guys. Let's get back to the show.
Yeah, no, it's a great question. And I've gotten that question many times, people looking at crypto as a store of value relative to gold. And of course, the one thing that gold has that crypto doesn't is physical properties. It's indestructible. It's been recognized as a currency for 4,000 years. Central banks do not own crypto in their reserves. They own gold. China, the biggest producer of gold in the world as a country, consumes all of its domestic gold production and is the biggest importer of gold in the world because they're rapidly diversifying their central bank reserves out of the US dollar into gold, as is most of the developing world, whether it's Russia and Venezuela, the countries that are dealing with political and economic strife are trying to protect their reserves by owning gold. They're not buying US dollars. They're not buying Chinese yuan. They're not buying yens. They're euros. They're buying physical gold because that is the ultimate currency. And particularly in this environment where interest rates on a real basis are negative, there's no financial incentive for them to own US treasuries or euro treasuries and like. So gold is definitely the ultimate currency. It's one that can't be duplicated. It's one that can't be printed. In fact, all of the gold that's been mined since the beginning of time could fit in 4 Olympic-sized swimming pools. It's tiny. So you can imagine a small reallocation of capital into gold, what that would do for the gold price. I'm talking about global capital. A fraction of 1% is in gold. So a small, minute amount of reallocation could drive gold up dramatically. But gold is the currency it is because it has that indestructibility and physical property. The problem with cryptocurrencies, by and large, is they're a figment of people's imagination. They're zeros and ones. There is nothing physically backing them. And what the failures of FTX and some of these other crypto purveyors have shown is there's nothing there but air. And that's the concern I have. At the peak of cryptocurrency valuations, there were 8,000 cryptocurrencies out there. So basically people were just inventing currencies and saying, buy mine, but there's nothing behind them. No intrinsic value. And that's my concern. Will the Bitcoins of the world survive? Probably, because they are the currency, the ticket to participate in the blockchain, and the blockchain is here to stay. It's driving out the middleman in many transactions. It's making transactions more efficient, secure, and you need digital currencies to participate in them, but you don't need 8,000 of them. And I think what will happen inevitably is central banks won't allow these digital currencies to basically continue to run the financial services sector. I think they'll domesticate them. I think they'll become fiat currencies like any other currency, which means that they can be printed and created with reckless abandon, which is the problem with paper currencies today. There's been this vast expansion of money supply, particularly since the credit crisis in 2008, to stave off financial ruin. And that's really depreciated the value of our savings. And it's resulted in this inflation. This inflation was inevitable because we've been basically baking it for a dozen years or more since the credit crisis. And now it's coming to roost. And again, the problem with cryptocurrencies is you can't control their supply. They can be introduced willy-nilly, and that's the same for fiat currencies. Every man-made currency since the beginning of time has failed at some point. The US dollar will fail someday. The euro will fail someday. The yen will fail someday, because every fiat currency ever invented fails because the temptation to create more of it is irresistible. Whereas gold is very finite in quantity. It's very difficult to mine. There's 2% added to supply per year. And that's declining because it's so hard to build new mines. So, it's about 200,000 metric tons on the Earth's surface. We add 4,000 tons a year through our mining efforts. And that's declining because we haven't been investing in exploration, and reserves in the ground have been declining. So there isn't this elasticity of supply to price. If the gold price goes up, it's not like the mining industry can say, "Oh, I'll mine another 1,000 tons this year." We can't do that because the reserves don't exist, and we're at 97% industrial utilization. There isn't the capacity for us to flick on the switch and add supply.
Yeah, so it's real tangible value, and I guess I know I didn't really pay attention to crypto until this last year because it was part of everyday conversation. I thought, okay, well, this is here to stay. But I really don't understand it. And I think what they're figuring out, or maybe they're looking to do, is to tie a coin. They could even call it the crypto gold coin or something, but say it's tied to gold. I don't know how they actually can do that. I can see how they can tie something to the dollar or the euro, because like you said, they're also it's basically air. It's based on this confidence in the GDP is really what all comes down to. And the people feel confident. Yeah, that everybody's happy and they make more money. But if there's a lack of confidence, everybody wants to get out of it. It just crashes, So, but I don't know if that makes a difference. It's almost like it would be a derivative if they had a gold, whatever the token or coin or something.
What you're describing is what the U.S. dollar was before Richard Nixon removed the gold standard. So effectively creating a digital or physically backed digital currency is what the US dollar was before it was decoupled from the gold standard. And so people want that security. They want some controls around government's inevitable temptation to expand money supply to finance their operations and undermine the value of our capital and our savings.
Yeah. So so now let's talk about the timing of it all, and I agree with you 100%. Everything you're saying about the economy and how things have evolved over the last, really since probably 2000, even before that, a lot of it goes back to the 1970s, obviously, but with recent events and when it comes to printing a lot of money with the pandemic, the U.S. in particular was just, it literally is just an open printing press. And the irony is, if you and I did that, we'd be in federal prison, but they're doing it. I understand there was an immediate need to avoid a catastrophe. I get that. But in times of crisis, our government should be able to take, dramatic measures like that, but not as a general course of business. And unfortunately, that's what they were doing. Now there's I'm not saying every single day, but they kind of are. I know Canada, when I was in Canada, same thing. I was trying to tell everybody, don't overspend. Don't spend more than you're bringing in taxes. And they did that. I don't even think they care anymore. U.S. or any of the first world countries, they just spend like there's like an endless supply. Mm-hmm. And now this is at least statistic, I'm assuming is true. For every living person in the United States, there's $100,000 debt on their backs just by being an American. $100,000 debt from the national debt. That's insane. I bet 95% of Americans don't even have $100,000 in savings. So with the way things are going, I've been saying for a while, I think inflation's here for a while. I don't think this is going to be a quick thing they're going to solve. I think it's going to be here for a while. We have to get used to it, and therefore we have to find returns that are going to help us hedge against those the voracious appetite of inflation. So when it comes to getting into gold, then it sounds like the royalties, which is tied to the mining itself, is probably the easiest way to go. Is that a correct statement? Or
not only that, but it's been empirically demonstrated to give you better returns over time. If you look at over the last decade, for example, the gold price went up about 20%. And so if you own the physical gold, you got a 20% return. That's not great over 10 years. It's 2% a year on an uncompounded basis. If you bought the mining equities, you would have only gone up about 2%. So they underperform the commodity because of the cost pressures I was talking about earlier on. Okay. If you owned the royalty companies, you would have been up 110%.
Wow.
So they outperformed the commodity more than fivefold and outperformed the mining equities almost 100-fold. And so that provided that leverage that I was talking about before, because again, it protected their shareholders from inflation while giving them full leverage to the increase in the gold price and to the exploration success of the underlying operators. So again, exploration upside, gold upside with inflation protection.
Okay. All right. Now, as far as timing goes, obviously this sounds like a great time to be participating in this. It's probably one of the best alternatives. But overall, is there another strategy? Let's say we go through the trough of a recession. We're coming back out of recession. We're on the uptick. Is there another strategy that works well then, or is there maybe a combination of strategies that you would use in a escalating market versus a declining market?
Sorry, and you're talking about escalating equity markets generally?
Relative to, correct.
Yeah, look, I think gold makes sense in an inflationary environment, regardless of what happens in the general equity markets. And I would say that right now, I think general equity markets are in peril because inflation eats away at their margins as well. What we haven't seen is a correction in the equity markets to reflect the ravages of inflation on margins. We've seen a compression of multiples, price to earnings, for example. But what we haven't seen is the next leg down when earnings actually come down. Mm-hmm. So that will result in another significant correction in the equity markets, in our view. When we get into an expanding earnings environment, that means probably when we're exiting inflation. At that point, maybe gold as an asset class isn't nearly as attractive, but it's hard for me to foresee when that'll happen, given we've been introducing this excess in terms of money supply since really 2008. It's going to take a lot longer than 6 months or a year to unwind those excesses.
Yeah, I agree. Okay, I tell you what, I know we're probably getting close on time here, but just purely out of interest, you mentioned China was the largest place where they're mining gold. What are some of the locations around the world where gold is more easily mined, or is it more of a supply?
Yeah, look, the US and Canada are still significant players on the gold production side. But I would say that from discovery to first production, typically it takes 20 years. It's so difficult to get mines financed because they're capital intensive. And also there's a lot of environmental concerns around getting new mines permits, social concerns. It just takes a long time. The industry has been very responsible for engaging with multiple stakeholders around the mine sites and doing things in an environmentally responsible way. But it does take a long time to get that social license and get the government permits you require to build mines, no matter where you are in the world. So I would say, as I said earlier on, it's very difficult for us to see a supply side response in our business, even as gold prices escalate, just given the long lead time to get new production up and running. Yeah.
And if we want to participate in the royalties part of the business, are we able to do that with any of the mines anywhere in the world? Like, do the Chinese mines avail themselves to us also as investors?
No, typically, if you want to get into the royalty business, you want to buy a royalty company like Gold Royalty Corp. We're listed on the NYSE American under the trading symbol GROY. We pay a dividend. We yield 1.5% already. And given our 60% compounded annual growth rate projected in our revenue, and again, a very, very stable cost base, we're likely to see, we believe, our dividends go up over time. And we have 215 royalties in the portfolio. That's a lot of optionality, a lot of diversification, which no mine operating company can offer you. Even the biggest operators in the world, Barrick and Newmont, have typically 15 to 20 operations. They're not nearly as well diversified as royalty companies are. So, we're much less exposed to the risks inherent in our business because of that strong diversification. So I would say, we're one of the best names in the space. We're one of the most liquid. We have a good yield and we have a growing cash flow profile and a tremendous exposure to the exploration upside of our operators, given they're investing on average about $200 million per annum on exploration on their properties, which we don't finance, but we get the upside from.
Yeah. Well, how can we, I know there's a lot of people probably listening to this, unfortunately, in their cars, so I have to write things down, but if you're listening in a car, you can always replay this. Also look in the show notes, because we'll put this information in the show notes too. So how can the listener find you online? Is there anything you can offer, even, advice and information that they can consume to learn more about this as well as participate,
Sure. Well, our website is goldroyalty.com. So it's very easy to remember. Our name is Gold Royalty Corp. Our trading symbol is GROY on the NYSE American. We have access to a newsletter on site, 1-800 number if you ever want to call and talk to any of us and talk about our business and ask questions. We're covered on the research side by Raymond James and H.C. Wainwright, BMO Bank of Montreal, Laurentian Bank Securities, and Haywood as well. So we have 5 fairly large dealers providing research coverage, so you can get some independent assessments of our business and some of our peer companies as well by subscribing to their research or just going online and finding it. Much of it is offered free. So there's many ways to get up to speed on the sector, but goldroyalty.com is where you'd find business specific about or information, specifically about our business.
Okay. Well, I'll tell you what, I appreciate you sharing that. So everybody listening, please remember goldroyalty.com and just start there. And we're really lucky to have David as our speaker today on the podcast. So if you wouldn't mind, when you're out there visiting goldroyalty.com, please leave a review for the podcast on whatever channel you're listening on, your favorite channel. We obviously appreciate the biggies, iTunes, for example. But whichever one you're on, we appreciate it. It's what makes the podcast world go around. And I think this has been a good one for you because we don't normally cover this. And boy, what a answer and a blessing based on what's happening in today's market to have an alternative like this, So go out there and do that. And while you're out there, before you leave the internet, go to globalinvestoragent.com, click on Learn More, particularly if you're a real estate agent and you're wondering what to do in this changing market. We have the answer, and it's work with investors, the people with the money. That's how you're going to make money as an agent. So go ahead and do that. We appreciate it. And then, David, thank you again very much for doing this. Maybe next time I'm up there in beautiful Vancouver, I'll look you up because one of the most beautiful places on the planet, and I really like it there. Wonderful people, and I'm not surprised you're there. And I'm sure you're looking to stay also,
Exactly. Well, thanks so much for having me on, Gary. It was my pleasure.
You're very welcome. Okay, everyone, we'll see you on the next Massive Passive Cash Flow podcast. In the meantime, take care of yourselves, and God bless you and your families.
Thanks for listening to this episode of Massive Passive Cash Flow. Be sure to go to realestatewithgarywilson.com to join our community and start building wealth today.